Are you looking for the best ETFs for long-term investing? Let's start at the beginning. ETFs, or exchange-traded funds, are a type of investment fund and exchange-traded product that you can buy or sell on a securities exchange. Essentially, ETFs are the love child of mutual funds and individual stocks, offering the best of both worlds. Like a mutual fund, an ETF is a collection, or basket, of tens, hundreds, or sometimes thousands of stocks or bonds in a single fund. This allows investors to diversify their portfolio without having to individually buy each component. At the same time, like stocks, ETFs can be bought and sold during the trading day at fluctuating prices. So why are ETFs important? Well, ETFs offer a way for investors to diversify their portfolios without the need to invest large amounts of money. They are also more cost-efficient than buying individual stocks and bonds. However, not all ETFs are created equal. When choosing an ETF for long-term investment, it's essential to consider several factors such as its performance, risk, and return. Performance refers to the track record of the ETF and how it has been doing over time. Risk pertains to the potential for loss in your investment, and return is the money you make from your investment over time, either through capital gains or dividends. Bear in mind that every investor has their own risk tolerance and investment goals. ETFs that may be suitable for one investor may not be for another. It's always a good idea to do your own research or consult with a financial advisor before making investment decisions. In this video, we'll delve into two popular ETFs, JEPI and QQQ. We'll explore their performance, risk, and return, and help you understand which ETF might be a better option for your long-term investing strategy. And don't forget to share your experiences and opinions on these ETFs in the comments below. Remember, the more we share, the more we learn. So let's start with JEPI. What exactly is this ETF all about? JEPI, or the JP Morgan Equity Premium Income ETF, is a unique investment vehicle designed to provide investors with consistent income alongside capital appreciation. It aims to achieve this by investing in large and mid-cap U.S. stocks, while also employing an options strategy to generate additional income. The fund's goal is to offer a higher yield than traditional equity investments with a lower risk profile. JEPI works by investing in a diversified portfolio of U.S. stocks, primarily from the S&P 500 index. It then sells call options on these stocks, which provides extra income. This strategy is known as a covered call strategy. When the market is stable or rising, this strategy can be quite profitable, but it can limit gains during a rapidly rising market. Now let's talk about the performance history of JEPI. Since its inception in May of 2020, JEPI has shown a strong performance with a return rate that has consistently outperformed the broader market. It's important to note, however, that past performance does not guarantee future results. In terms of risk, JEPI falls into the moderate risk category. This is because it invests in equities, which can be volatile, but the covered call strategy helps to mitigate some of this risk. The ETF also has a very competitive expense ratio, which is another plus for investors looking for cost-effective investment options. The return rate of JEPI is another key point to consider. The fund aims to provide income through dividends and option premiums, which can enhance total returns. As of now, JEPI has a robust yield, which is quite attractive for those seeking a steady income stream. So in a nutshell, JEPI is a fund that offers a unique blend of income and growth with a moderate risk profile. It's a great option for investors looking for consistent income with the potential for capital appreciation. Stay tuned as we delve into our second ETF, QQQ, and remember, your opinions matter to us, so leave a comment below. Now, let's move on to QQQ. What makes this ETF stand out? QQQ, also known as the Invesco QQQ Trust, is an exchange-traded fund that aims to replicate the performance of the NASDAQ 100 index. This index includes 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market, covering a wide array of sectors. Here's a fun fact. QQQ is one of the oldest ETFs in the market, having been launched back in the year 1999. Since then, it has grown in popularity due to its focus on tech and growth stocks. Now, let's dive a little deeper into how QQQ operates. This ETF uses a passive investment approach, mirroring the NASDAQ 100 index. As a result, it holds a variety of stocks from big-name tech companies, including Apple, Microsoft, Amazon, and many more. When it comes to performance, QQQ has a solid track record. Over the past 10 years, it has consistently outperformed the broader market. This can be attributed to the strong performance of the tech sector, which dominates the Nasdaq 100 index, and by extension QQQ. Risk and return are two sides of the same coin in investing. QQQ is considered a moderate to high-risk investment due to its concentration in the tech sector. However, it also offers high return potential, especially for investors with a long-term perspective. Remember, investing is not a sprint, it's a marathon, and in this marathon, QQQ has proven to be a resilient runner, navigating market volatility while providing substantial returns. In conclusion, QQQ is a unique ETF that provides exposure to some of the most innovative and influential companies in the world. Its performance history, risk level, and return rate make it a compelling choice for investors seeking growth potential. Coming up next, we'll compare these two ETFs head-to-head. And don't forget to subscribe for more insightful videos like this. It's time for the face-off. JEPI versus QQQ. Which one comes out on top? Let's dive right in. Picture this. Two heavyweights in the world of exchange-traded funds, each with their unique strengths and strategies going head-to-head. On one side, we have JEPI, or JP Morgan Equity Premium Income ETF, a relatively new player that aims to provide investors with a steady income stream and capital appreciation. On the other, there's QQQ, or Invesco QQQ Trust, a seasoned veteran that tracks the Nasdaq 100 index and focuses on large-cap growth stocks. Let's start with performance. Over the past year, QQQ has delivered strong returns thanks largely to its exposure to tech giants. JEPI, however, hasn't been far behind, with its unique strategy of selling options to generate income and boost its yield. Both have shown resilience in the face of market volatility, but QQQ has the edge when it comes to raw performance numbers. Now let's talk about risk. QQQ, with its heavy tech concentration, can be riskier during market downturns. JEPI, on the other hand, aims to provide a smoother ride by diversifying across sectors and using options for income. So if you're risk-averse, JEPI might be more your speed. As for returns, QQQ has been a stellar performer thanks to its focus on high-growth tech stocks, but JEPI, with its income-oriented strategy, provides a steady stream of cash flow that can be attractive for income-focused investors. In terms of major differences, QQQ leans heavily on the tech sector, while JEPI offers broad exposure across sectors. QQQ is all about capital appreciation, whereas JEPI aims to balance growth with income. That said, they do share one key similarity. Both are managed by highly respected financial institutions, which provides a certain level of assurance for investors. So which one comes out on top in this face-off? Well, that depends on your investment goals and risk tolerance. If you're after high growth and can stomach some volatility, QQQ could be the one for you. But if you prefer a more balanced approach with a focus on income, JEPI might be your champion. Keep watching to find out which ETF we recommend for a $100K investment. And remember, we want to hear from you, so leave a comment with your thoughts. So you have $100,000 to invest. Should it go to JEPI or QQQ? Well, let's look at it tactically. Both JEPI and QQQ offer unique opportunities for long-term investing. JEPI, or the JP Morgan Equity Premium Income ETF, focuses on providing a steady stream of income through option writing. This strategy results in a higher yield, making it an attractive option for investors seeking consistent income. On the other hand, we have QQQ, the Invesco QQQ ETF, which tracks the Nasdaq 100 index. This ETF is heavily skewed towards technology and innovative companies. So, if you believe in the power of technology and innovation, QQQ might be the way to go. Now let's consider the risk factor. JEPI's strategy of option writing can lead to higher volatility, meaning the price can change rapidly in a very short time. This could potentially lead to significant gains, but also substantial losses. Meanwhile, QQQ, while not immune to market risks, generally offers a more stable performance. When it comes to returns, both ETFs have shown strong performance over the years. However, QQQ's focus on tech and innovative companies has resulted in impressive growth, especially given the tech boom of the last decade. JEPI, while providing consistent income, may not offer the same level of growth, so where should your $100,000 go? Based on performance, risk, and return, our winner for today is QQQ. With its focus on tech and innovative companies, QQQ offers the potential for robust growth over the long term. While JEPI's high yield is certainly attractive, the higher volatility and lower growth potential make QQQ a better choice for a large investment like $100,000. However, remember that every investor's situation is unique. What works for one may not work for another. Always consider your financial goals, risk tolerance, and investment horizon before making any investment decisions. That's our take on JEPI and QQQ. Do you agree or disagree? Let us know in the comments. And remember, investing is a marathon, not a sprint, so make sure to subscribe and stay informed.